Last week was a bit of a crazy week in the markets. Lots of news, kind of different news as well. We're going to get into that. And the markets moved higher. It just seems the markets move higher up on any news, good news, bad news. Everything seems to be good news for the markets, and they just seem to move higher. Maybe there's a little bit of FOMO going on. We'll take a look at what's going on in the markets a little bit around that, but maybe there is just a little bit of FOMO, and that can keep going on for a long time. In fact, a year, 2 years as well. But we'll look at some of the factors driving the market last week, and also we'll take a look at what's coming up this week as well. So let's jump right in and start by taking a look at the ADP numbers that came out last week, because that's all we had really as far as big employment numbers. We didn't have the non-farm payroll number. So if you take a look at this graph for ADP, here you can see the September ADP number came in at negative 32,000 jobs. That is not a strong number. That was well below expectations. That's not a good sign. And on top of that, we had August being revised downwards as well. Also not a good sign for the ADP numbers. But if you actually dig into the industries that were hiring and not hiring, it actually is a little bit worse. So here are the ADP numbers broken down by industry here. Here's education and healthcare. Look at this, huge numbers here in the hiring. This has actually been consistent over the last few months for healthcare. And I don't understand what's going on as far as that goes. I mean, obviously there might be some seasonal elements in there, even in the de-seasoned numbers. But if you take a look at natural resources money, weak, information weak, negative. We've got manufacturing negative, construction, trade, transportation, utilities, financial, leisure, and hospitality. All these industries here were negative. This is not what you want to see. This is not the sign of a healthy economy when it's driven by education and healthcare. You really need these sectors to be showing strength, and that was not the case for the September ADP numbers. This graph shows ADP numbers, and you take a look in the white, you can see here that it is going down. The downward trend for ADP continues. Well, let's see what happens when the non-farm payroll numbers do get released, when the government starts up once again. Right now, it's not looking great for the employment picture. Last week, we saw large cap pharma. It was up actually 9% in one day. Really strong trend here. This was based upon Trump, the White House signing a deal with Pfizer around the medication for Americans. Some of it was around pricing, giving Americans better pricing. They actually pay some of the highest prices in the world for pharmaceutical products for themselves. In fact, the Canadians see this because the Americans cross the border for cheaper pharmaceuticals, so they're looking to get lower pricing as well. Trump backed off on his 100% tariffs on pharmaceuticals coming into America. It opened the door for more negotiations as far as that goes with companies that are making an effort to do some manufacturing in America. But we'll have to see. Anyhow, the market liked what they saw. Every piece of news that came out last week seemed to be good news, including the news around the pharma deal. Later in the week, we saw the ISM PMIs come out here, and this is for services. The manufacturing came out. We'll take a look at that in just a second here. This yellow line here is the ISM services prices. Now, if you take a look, what that means is this is inflationary. We'll take a look at that in just a second. Services makes up about 70% of the U.S. economy, and it has been holding in. So this is the purple line here. You can see, but it has been positive above 50, because that's what we're looking at here. Anything above 50 means that the services is expanding. When it's going down, declining down, that means it's expanding at a slower rate. When it crosses below 50, that means it's actually contracting. And so we actually take a look here. It ended up right at 50. So not a contraction, not an expansion for services. And this has really been the part of the economy that's been holding up the economy, really, because manufacturing hasn't been doing well. So that's the big news here, is that we saw the services really weaken here down to 50, and we saw prices head higher. Okay, so here's the ISM manufacturing PMI, so the smaller part of the economy. You can see here, here's the 50 line here. We actually came in at 49. It was a survey. It came in at 49.1, so approximately equal to expectations, which means a slight contraction. And you could argue that we have seen a trend upwards for manufacturing, but this overall, being below 50 means that the manufacturing has actually been in contraction as far as that goes, according to the way that this is calculated with the ISM manufacturing. It's good that we are seeing a little bit of an uptick here, and we are seeing a trend higher, but we're still in a contractionary phase for the manufacturing. This graph shows the ISM services PMI prices. So we saw that earlier on with that yellow line that was rising. So here it is in white. And in the blue line is the CPI, so the headline rate of inflation, which is currently 2.9% in the US. So there is a relationship between the two of these. And this is why it's a little bit concerning. If you take a look at this white line here, we can see that it bottomed. So the ISM services PMI prices bottomed and started to head higher. So the prices that businesses are paying start to head higher before the CPI, then the CPI turned higher. Then we saw the ISM services prices head lower before the CPI started to head lower. And then we come down to the bottom here. It's about the same, really, as far as bottoming out here a little bit. But we have seen this heading higher here while the CPI has been heading lower. This is a concern because this is heading higher here, which means we might see the CPI head higher. Now, the bottom line is here, a lot of people are wishing that inflation was killed, defeated, and it was all done. But inflation is an insidious process that really grabs hold of the economy. It really does a lot of economic destruction. It takes time and willpower to kill inflation. It looks like maybe we're doing a good job here, but there's some indications that inflation actually is still lingering around at this point. I want to show this graph here. So there's different ways to measure inflation. We take a look at core, we take a look at CPI, etc. Here is an organization called Trueflation that calculates inflation according to the old standards. So they're not using hedonistic adjustments and saying, well, we're going to substitute products, or your car goes faster, so therefore you're paying more, but since it goes faster, we're going to count that as paying the same. Those type of adjustments. If we take a look here, they've calculated on October the 2nd here, rate of 2.25%, which is lower than the CPI. But here's a concerning trend. We did see this rate actually go down lower, come back up here, and it has been heading higher here. So a lot of people were looking at this rate earlier on, Trueflation, saying, look, we're down to 1.2% and it's all done. We should be cutting rates. Inflation's dead. But we've seen inflation come back up. In other words, it hasn't been killed yet, so we have to be a little bit cautious. Here's an interesting one. Here's USA rare earth rises on discussion with Trump administration. And this happened on Friday. So just to go back a bit, Trump took a position in Intel, supposedly for free, 10% of the company, etc. And I'm not going to get into it. This isn't about politics, but I just didn't understand that one at all. Stepping in to take a position in a company, it's picking winners and losers. I'm not a big fan of that. I think the government should try and stay out of the way of that. But that was the first step. And then we saw Trump go on and make announcements with a couple other companies. One was the Lithium Americas Corporation as well, taking position there. And then we saw MP Materials as well, take a stake in there as well. Their grants, their loans, etc., back and forth. So I think what they're trying to do at this point is they put a lot of tariffs up around rare earth metals because these are critical elements. I mean, 95% of them are basically coming from China at this point. And the U.S. actually produces very few. And yes, there are tariffs, but Trump is saying, well, we really need to kickstart this, so let's subsidize them, essentially. A little bit of a dangerous precedent. And then on Friday, we saw the CEO of USA Rare Earth come out and say on CNBC that, yes, they are in discussion with the Trump administration. So I'm not sure how many companies this is going to happen to, but we could see this roll out further. I don't think this is just going to stop at 3 critical earth companies. Maybe down the road. I mean, if you take a look, Apple's actually taken a position in some rare earth companies. GM has as well. They're trying to protect their supply chain. America's actually doing it because they want national security. A lot of the defense stuff requires critical rare earth metals. And as well, a lot of businesses. So I think they're trying to build this up at this point. So I I see this trend continuing here at this point, but we did see a large rise for this one company on Friday. Watch out for speculation. You're going to start to see people coming out and saying, well, who's the next company? And you're going to start to see betting on that take place. This is what used to happen in the resource sector back in the early 2000s. Okay, so let's take a look at some of the performance last week. The S&P 500 is up 1.1%. Healthcare. So here we are. We talked about that earlier on. It was definitely the winner here. Utilities. Now, utilities is interesting because it is considered a defensive sector, but it's got this higher beta element now that we've got this data center with AI. So it can really move on risk-on days, too. And we saw that last week as well. Consumer staples really lagged here. Energy, just getting no love here. I mean, we saw OPEC this week come out and say over the next few months they're going to start increasing production. And we're also seeing on water storage increasing for oil. Longer term, there's a great picture for the energy sector, but in the short term, it just keeps getting higher. It's hammered. It's around $60 for a barrel for West Texas at this point, which is kind of interesting. Technology, we saw that risk-on move, so technology bounced back. Technology is outperforming the market. I think this is the big sector you want to watch. As long as the sector is outperforming the S&P 500 and performing well and positive, I think the market still has a risk-on slant here. If we see the technology sector start to falter a little bit, I think that will ripple through the other sectors as well. But the overall story is that, yes, the market was positive once again. Typically, it's a weaker time of year, but the market just seems to be moving higher at this point. If we take a look here in the markets, here's the S&P 500, 1.1%, the NASDAQ up, right, 1.3%, small caps. So we had that risk-on move. Small caps have been going back and forth as far as that goes. October, small caps can pick up, but usually a little bit later on. TSX going up here. We saw the Shopify do extremely well this week, and the miners are doing well. So all of those add up to the Canadian stock market performing well. China, okay, also performing well, and emerging markets. So this was definitely what we call a risk-on week as far as investors' attitude goes. If we take a look at some of the sectors in the market, metals and mining, okay, so when you see metals and mining go up by, 6%, that really helps the Canadian stock market perform well just because of the constituents that make up the market as well. Natural gas perform well. We are in that strong seasonal period for natural gas. It can perform well up until basically mid-December. Uranium bouncing back. We saw uranium perform really well for a while. It's up almost 18% in 1 week. It's really been digesting a bit here. But we're starting a strong seasonal period, actually, on a historical basis coming up shortly. So we could see that actually after maybe even a little more consolidation, it could perform well. I'm surprised that when you see the metals and mining sector perform so well, that usually helps the uranium sector. And if you want to see a really supportive combination, energy performing well, plus metals and mining performing well, plus the market's going up, that usually is a back tailwind for uranium to do well. Home builders up 1.6%. This is definitely a risk on as far as the market goes, because this sector here, I mean, every report coming out from the home builders, Lennar in particular, it's just been absolutely disastrous as far as their outlook goes. But this is like a knee-jerk reaction to what's happening with interest rates at this time. Interest rates move down, then everybody says, oh, home builders, people can buy homes on the margin, etc. So we've seen it perform well. U.S. banks, look at this, not performing well here. And this is, not a great sign for the economy. It's interesting. Often these are related. If you get into the regional banks, these two can be related here a little bit. Agriculture can perform well this time of year. We'll have to see. Semiconductors doing well. Gold, okay, once again, 3.4%. Look, it's been on a tear. I have to say this about gold. Look, I think there's a lot of reasons why gold's performing well. I'll shoot a video just on gold. Like, I love gold for the long term. The governments continue to act recklessly and irresponsibly across the board. I'm not picking on any government because they're all doing it. And they just refuse to accept any type of fiscal responsibility and say, well, we have to because of this. It's shockingly bad as far as that goes. And investors are saying, well, we're not comfortable with that. And as interest rates rise, they're pushing rates even higher. And so one of the options they're looking at is gold. And I talked about this in the last week's video about Gunlock saying 25% is not an unreasonable position of portfolio. That's huge. I think it was Morgan Stanley came out and said, well, 60-40 is dead. It really should be 60-20-20, with 20% being precious metals, i.e. gold, which is kind of interesting as well. Retail performed so-so as well, transportation as well. So we really saw some of the cyclical sectors perform well. Silver obviously performed well with gold at the same time. Okay, so here's the Canadian stock market. Here, this is technology. So the sectors in the Canadian stock market are a little bit thin, so you have to watch out. This was largely from Shopify performing well. Healthcare did well. Now, this is still on the back of Trump actually put out a tweet earlier on. I think it was earlier this week or maybe on the weekend, last weekend, promoting CBD and saying, hey, we should move towards more CBD legalization or stop charging people for minor amounts. It was kind of an interesting little tweet that came out, and we saw the marijuana sector perform particularly well. And so we do have a little bit of that element in that as far as Canada goes. The material sector in Canada, that's gold miners, a lot of that sector as well, industrials performing well. But the big story was the technology sector. And if you take a look here, here's Shopify. In Canada, here's the beginning of the week. Just happens to be like we go down last week and we go back up this week. And that's a huge gain, which drove that sector higher. Okay, the market's doing well. It's just ignoring everything. All the news is good news for the market. Either it's bad news, which means that the Federal Reserve will cut rates faster, or it's just good news and the investors go, well, that's good news. As far as the economy goes, it means it's strong, so therefore earnings will be good. We're kind of up to earnings season shortly as well, which will be very interesting coming out mid-month here. We're starting to see financials back off here a little bit, so that could be interesting because they're the ones that kick off earnings. But if we take a look at VIX, so the most volatile month of the year, on average over the long term, has been October. Now, on average, October is positive on average. But it is volatile. So we can see some corrections, and it often leads to some good buying opportunities as well. What I'm finding interesting here, though, is I'm finding that interesting that we're seeing VIX over the last few days popping up here, even as the market's gone higher, which is rare. As far as that goes, on a consistent basis, on a 1 or 2 day basis, yes, that can happen. But we've seen the markets perform well, and at the same time, VIX actually moving up with that. I don't want to read too much into that, but we are seeing VIX move higher off of a little bit of a bottom here. And we are in that volatile month where we could see a spike in VIX as well. So it depends on the news coming out, of course. But this is the month where we tend to see some volatility take place. Okay, so this week, we don't really have a lot of news as far as the U.S. market goes. I mean, the JOLTS, et cetera, are not going to be released with the government shutdown. I'm expecting the government to continue the shutdown for quite a while, from what I've seen here. The market's just going, well, that's fine. We've been through shutdowns before. There's money in the Treasury General account. They'll spend what they have to spend. But this could get really political as well, so it's going to be interesting to see how that works out, if that's going to stop a shutdown here. Because when the government shuts down, the power goes from Congress to the executive branch. And people are fighting Trump all the time and saying, well, the executive can't do that because you don't have the power. It has to be Congress. Well, when Congress is shut down, the power gets transferred to the executive branch. So that is going to be interesting. In fact, what's going to be interesting here coming up is the tariffs in the U.S. Trump's tariffs have been, in appeals court, have been denied twice. There's another ruling coming up mid-October. I think it's either the 14th or the 17th of October. So very shortly. This actually might provide an out for Trump. The issue is, it's not that the tariffs exist. A lot of people say, well, the tariffs just can't be put in place. The issue in the court's eyes is that Trump has used his executive powers instead of through Congress to implement the tariffs. The court says this has to go through Congress. Now, if you think about it, so let's say the government does come back, or the courts do come back and say, hey, no, you know what? This is definitely a Congress issue. It has to go through Congress. Well, if Congress is shut down, Trump and the White House can say, well, they're shut down. We have the power now. So this might buy them some time and give them an incentive to not get the government back to work. Like it's kind of a bizarre twist. I haven't heard anybody else talk about this. Maybe I'm wrong. I'm not a U.S. constitutional lawyer, but I'm just putting two and two together here a little bit. But this actually could give the White House a little bit more breathing room to implement the tariffs for temporarily until Congress gets back and starts to do the work. So it's going to be very interesting, once again, from the U.S. perspective. In Canada, the government still is operating here. And on Friday, we do see the net change in employment coming out. The expectations are for a negative 10,000 jobs. And don't forget, we saw that really weak number, negative 66,000 jobs. So still negative. We're still looking at employment going down, which is not a sign of a healthy economy. The Canadian numbers are hard to read because it can be lumpy, but when you see consistent negative numbers, that's not a good thing. The expectations are that the unemployment will move from 7.1% to 7.2%. Starting to tick higher and higher. We see the trend here in Canada, and I think the U.S. is going to also see this trend as well. The unemployment, I think, is going to head higher. They've got different dynamics going on, but Canada's economy is quite weak at this point for a number of reasons. It has been for a long time. It's not the tariffs so much. Absolutely, the tariffs do not help. But the tariff effect really hasn't kicked in. It's just starting to kick in. We've just got a weak economy structurally here. So we'll have to see what happens. But this number here at 7.2% is starting to become a little bit concerning. This graph shows the Canadian unemployment rate back from 2016. Here is where we are right now at 7.1%. And so we can see we've been climbing, a little bit flatter here. But I would not be surprised to see us get to 8% here. There's not being a lot done to generate a lot of employment, especially from the private sector at this point. And we are seeing some decay taking place. So I think if we do get up to 8% here, that's when I think people start to say, well, now we're in trouble. And don't forget, unemployment's regional as well. Like, for instance, Ontario already has a higher rate than, let's say, Alberta, etc. So some provinces are suffering more than others. But as a nation, I think if Canada gets to 8%, that's when there'll be a lot of like, oh my goodness, we're in trouble here a little bit. And people will be running around saying, well, maybe we should cut back our spending personally and not to spend so much on our discretionary budget, etc. So hasn't happened yet, but it's just something to watch out for. My magic number is 8% on that. I just want to end this video on the S&P 500. Here we are. Another all-time high. Look at this. I mean, we're just heading up straight here as far as this goes. I mean, yes, we can start drawing little wedges here as far as this goes and goes, yeah, it's consolidating a bit, but overall it's going pretty straight. And we are seeing a divergence from price with the RSI, so price momentum is declining, but really not that much, not significant. It's not like RSI was down at 50 here, and we've really seen this take place. So it's only been slight here. So technically, the market can still move higher. There's no real resistance. I do believe we are seeing some FOMO. There's people coming into the market that haven't invested before. It's funny how, hang out at Starbucks, working on the weekends, etc. You're hearing chatter about, which stocks or which sectors and etc. from people. And a lot of them are fairly new to the market. So I just find that an interesting phenomenon to take place. So maybe you are having a little bit of FOMO, but really in the end, that doesn't really matter because the market can keep moving up significantly for the next year, 2 years, and keep going. And we've seen this in the past here. But right now, from a technical perspective for the S&P 500, it has been moving higher. It doesn't have resistance. We are seeing some price momentum declines, a little bit concerning, but nothing significant at this point. But once again, October is the most volatile month of the year, so maybe we do see some volatility take place. And if something happens, it changes the narrative in the market, so it becomes a little bit negative, and investors all of a sudden start to worry about employment, or it starts to roll through. Maybe there's some trigger with the government shutdown with employment. Trump starts to lay off people, or the White House starts to lay off people in the government, et cetera, et cetera. And there's another interesting fact, and that is October 1st was the first day where the notices are really being sent out en masse to students, student loans in the States that have really, there's been a lot of a rollover on those loans, but now they're actually trying to garnish wages for those loans as of October 1st, which is going to be a little bit of a shocker for a lot of people. So 43 million people in the States. Yeah, 43 million. I never forget that. I did this video on not so long ago, maybe a month or two ago. There's 43 million people in the U.S. that have student loans. And you'd be surprised at the number of 50-plus year olds that have student loans. And so they've just been rolling over these loans. And some of them just, they paid off so much, but their loan is actually much higher than when they started. So what if people have to start paying into or paying off their student loans over time, even if they can afford it, it's still going to reduce discretionary spending somewhere else. So it's going to be $400 removed from somewhere else to pay for their student loan. If they don't pay their student loan, it's going to hit their credit score, which means they won't be able to borrow, etc. So, maybe that changes the narrative. But right now, investors are very bullish on this market, but I do think we could see a little more volatility in this market. We are starting to see it head up here a little bit. Thank you very much for joining me this week. And if you like this video, please give this video a like and subscribe to the channel. Thank you very much.